US jobs growth was much weaker than expected in October, but the Fed is still on track to cut rates 25 basis points later this week. December is not as certain, though, for another cut. And watch out this week for more stimulus news from China. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ Head of G3 Economics Brian Martin teases out how the Fed, global financial markets, and bond investors in particular are going to view either a Harris win or a Trump win in this week's elections.
If you get large tax cuts with no offsets, really, except for tariffs, that could be deemed to be inflationary because it's going to increase demand, whilst similarly restricting the supply side of the economy in the short run.
But first, in 5 and 5 with ANZ. In global markets on Friday night, a surprisingly weak non-farm payrolls report for the US jobs market in October dominated. Jobs rose just 12,000 in the month, when over 100,000 new jobs were expected. US stocks rose around 0.4%, and the US 10-year yield touched a 4-month high of 4.36%. That's up 7 basis points on the day. ANZ Head of G3 Economics Brian Martin says the October figures were affected by hurricanes, and the markets were expecting a rebound in November. He says the downward revision of 122,000 for the previous 2 months was probably the most interesting feature in the data, along with a deceleration in private sector job creation.
For example, jobs in the professional services and business sectors, they've actually been negative now for 5 months consecutively. And the pace of employment in the leisure and hospital sectors, that's been slowing down. The 6-month moving average of that is running well below half of what it was this time last year. So I do think all those are indicative of areas and pockets of the labour market being soft and really showing that monetary policy is still continuing to force a rebalancing in the labour market.
As of 4 a.m. Sydney Melbourne time, the US dollar index was up 0.32%, while the Aussie dollar was flat at 65.59 US cents and the Kiwi dollar also broadly unchanged at 59.63 US cents. Number 2, Brian says the jobs data leaves the prospect of a 25 basis point cut by the Fed intact for later this week. But December is still no sure thing for another cut.
I think the data are consistent with the FOMC cutting rates 25 basis points. Not only are there some evidence of ongoing rebalancing in the labour market, which is indicating inflation pressures are subsiding, but we did have a soft employment cost index for Q3 that was up 0.8% in the quarter, implying that wage costs in the economy are easing. And the PCE deflator for September, well, the headline was really back at target. So I think the Fed can be comfortable that there is sustained progress on inflation being made. And with the labour market rebalancing, they can cut rates with a view to trying to underwrite full employment going forward. As far as December is concerned, I think that's much more an open question.
Number 3, another major factor to watch this week is China's rolling stimulus program and what comes out of a key planning committee meeting this week. ANZ's Group Chief Economist for Greater China, Raymond Yung, says there are expectations in the market for a 10 trillion yuan number, but he says be careful in interpreting that.
So the 10 trillion number or the bond issue is simply to support a swap program. It is a campaign to de-risk the local government exposure to the hidden liability on the LGFV platform. And the ideas of the Chinese Minister of Finance is to relax the budget constraint of local government so that they will be able to focus more on domestic economic activities and development. But the impact will be very, very gradual and unnoticeable across 3 years. So if we get the number of 10 trillion bond issue, don't be too excited.
Number 4, another market watching the US elections closely is gold, says ANZ senior commodities strategist Daniel Hines.
A lot of the support we've seen for gold over the past couple of months is really driven by that political uncertainty in the market at the moment. For a lot of investors, gold suits that defensive sort of play that they could withstand, I suppose, a large number of the potential outcomes that we see out of that market. So demand as a consequence has been relatively strong.
Number 5, another factor is the risk of ever-deepening conflict between the United States, China, Russia and Iran, all of whom have been big buyers of gold as they try to avoid holding US dollar assets that could be seized, as happened when Russia invaded Ukraine. Here's Daniel again.
Obviously, the broader sort of geopolitical landscape is quite challenging, but also the move by a lot of other countries to diversify away from US dollars themselves. And I think that's going to be an ongoing trend which will continue to support demand for gold.
Daniel Hines there. Now, in our bonus deep dive interview, ANZ Head of G3 Economics Brian Martin teases out how the US Federal Reserve, global financial markets and bond investors in particular might view either a Harris win or a Trump win. I started by asking how the Fed's decision just 2 days after the election may be affected.
I think the FOMC will be completely independent and disconnected from it. The central bank is independent. The meeting is actually delayed a day because of the election, but I think they're going to very much be focused on what the incoming data is telling us and what they believe is right to do for the economy. So I think this is going to be a decision that's made completely independent of what the political climate is at the time.
There has been a rise in longer-term bond yields in recent weeks. How much risk is still left in there if Trump was elected from a fiscal expectations point of view?
The market's very nervous about that, and it's certainly a narrative that everybody's aware of at the moment. Were there to be a Republican clean sweep, I think the markets would be concerned that the president could deploy quite an expansionary fiscal policy. And I think by that, what we're looking at is tax cuts being extended for high, low and middle income earners. I think we're looking at tax cuts for the corporate sector, but there's no clear offsets to that being announced really outside of tariffs. And that cocktail of higher bond supply, along with tariffs that could, at the margin, prevent foreign buyers from participating as enthusiastically as they have in the past in owning US treasuries, that just raises concerns that bond yields could continue to push higher. And I think the markets will be watching that very closely as the election results come in.
And in terms of economic growth and inflation and what happens at the shorter end, is there a difference in views on the respective candidates about who's more inflationary than the other, so to speak?
I think there is. I mean, from a demand side perspective, if you get large tax cuts with no offsets, really, except for tariffs, that could be deemed to be inflationary because it's going to increase demand, whilst similarly restricting the supply side of the economy in the short run. The policies that both candidates have announced on immigration vary quite differently. Trump has been indicating that there could be up to 11 million illegal immigrants deported. And that could have quite a big impact on reducing supply in the labour market, which would be inflationary. Kamala Harris has been suggesting that she wants a more progressive immigration policy. Yes, she wants to control illegal immigration, but that there has to be an acknowledgement that immigration is positive for the economy. It's necessary for the economy to grow and to have a much more orderly framework in place. So I do think the markets would view Trump as being more inflationary than Harris, certainly in the short run.
And just finally, the prospect of a divided control of Congress and not a clean sweep is one of the options. How do you think markets and investors might view a divided set of arms of power in the United States between President, Congress, or House of Representatives and Senate? Because that's one of the options. You get a Republican president, Democratic House, and a Republican Senate.
Absolutely. I actually think the markets would respond favourably to a mixed Congress. I think if you have a checks and balances in the system, that's certainly going to ease fears that you could get a very profligate fiscal president. I think if you had a Harris presidency with a Republican Senate, that would provide significant checks to the type of spending that President Harris would want to put in place if indeed she's elected. Similarly, if it was Trump with a Democrat House, that's going to provide some checks and balances. But I do think if it is going to be a Republican Senate, the Senate Budget Committee will be quite hawkish in that environment. So I think, irrespective of who's president, they are really going to try and push for some offsets to try and contain the rise in the budget deficit over the lifetime of the next presidency.
Brian Martin there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, November the 4th, the day before the US elections, which will dominate our coverage of global financial markets and the global economy this week. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.